Welcome to the AI Fin News channel. The most relevant news and analysis from the world of finance and cryptocurrencies. The working week is over, which means the S&P 500, gold, oil and other traditional assets have gone into the weekend. But in the cryptocurrency market, no weekend. And today, as always, on Saturday and Sunday, we're paying tribute to tradition. Saturday's edition is dedicated to the of assets. We're looking at the actions of cohorts of players. We'll also be taking note of, or rather not forgetting, interesting moments in the markets. And I would like to start with the close of the S&P 500. In general, you can see for yourself that the S&P 500 closed in negative territory, after a couple of serious down days, because of the Federal Reserve's decision to keep its policy aggressive for a decent period of time. Of course, we did not have the collapse of yesterday, but consider this: 320 companies closed down, 168 closed up. The large capitalization is split 50-50ths. Either with small gains or sometimes with big losses down. Just look at Tesla. It's been a bad week for the S&P 500, and one thing fueled the fire. The S&P 500 yesterday was fueled by one index, just the D1 index. The geography of this index is different. Europe and America got data yesterday on the Manufacturing Activity Index, in the manufacturing sector. And the services sector, I'm going to decipher. But for Europe, let's start with Europe. Yesterday morning began with a modest rise in the composite index of economic activity in the Eurozone on the back of a recovery in the services sector. The rise in the all-core index was by improvements in Germany and the periphery. This index fell by 1.9 percentage points, well below consensus expectations. And yesterday it was commented on by Ban Sachs. She said, first of all, despite a slight improvement compared to last month, the momentum growth in the Eurozone remains weak in both sectors. In the country's press releases, this explained this weakness by the low level of domestic and external demand. Second, inflationary pressures continue to ease. As evidenced, this is reflected in the continued decline in output prices. However, recent increases in input prices point to the risk of higher prices in the future. Third, the rate of growth in the UK is slowing and falling. This, in turn, is accompanied by a weakening labor market and lower underlying inflationary pressures. So European data almost never affects the S&P 500 or rarely. And then there's America. Here we see more serious numbers for the markets. In the US, over the past few months, so-called hard real macroeconomic data have been consistently and disappointing. While the softer data that's based on surveys have been much better, which has led to between hard and soft data, that's the top chart, has reached a 2-year high. Yesterday when these indices were published, a mixed picture. The indices moved from Europe to the US. Manufacturing index rose in September, breaking a losing streak. However, the services sector index was a big disappointment, falling to its lowest level since January. Looking ahead to the market, the September data has raised concerns about the trajectory of changes in demand in the US economy following higher interest rates and rising inflation. Although overall interest in business remained above the sacrosanct level of 50, it was insignificant. The services sector lost further momentum and the decline in new orders accelerated. The fall in demand did not translate into overall job losses in September. However, the ability to find and retain led to an acceleration in the pace of employment growth. Nevertheless, the rise in the number of vacancies was caused by an increase in the number of may prove unsustainable as a result of an increase in the number of may prove unsustainable against the background of growing spare capacity and declining levels of unfinished, which had previously supported the pace of workload growth. Here it appears that two simple indices, but there's a broad economic component. If the trend is not reversed, this could have very serious consequences. Bad dream for the Fed and the ECB, it's called stagflation, with all the serious consequences for the economies of America and Europe. The dollar index has been rising, but in the last week we've seen the word I mentioned earlier today: stagnation. Some call it consolidation, or it's been since the 21st after the Fed hike. But in the week's gains are putting pressure on a lot of assets. In what way? Well, first of all, we know that both Bitcoin and gold, which are the two charts next to each other on the top right, have been nothing this week. In fact, even Bitcoin is up slightly since Monday, which you can see again on this chart, but overall, Bitcoin had a boring week in terms of price. But there was still volatility, which is what represented by the head of Simpson's head. Gold had pretty much the same situation. It started the week at where it ended the week. You can see the volatility in oil, which has fallen slightly over the course of the week. Looking at this chart, members of the Federal Reserve, probably stocking up on popcorn, they're saying come on. Since we've been talking a lot about oil this week, I can see why they're so cautious. They're saying the S&P 500 is going to be all over the place this week. Especially after the AliExpress meeting. A broad-based collapse in all the indices for yesterday and this week. It started the week strong, but after the Fed, there's no chance of a rally as we can see. As far as trading activity is concerned, according to the Intesa Block indicator, we see some, but I wouldn't say negative. First of all the dips are still being bought back, as evidenced by the green ball from 25,700 to 26,500. And the second positive, we don't see the old holders are showing signs of a major sell-off, because there's a lot of coins in the red on the other side. As a reminder that the block itself interprets its indicator as the strength of support and resistance levels. The way down is freer than the way up, but that's what I see. If you look at these green and red balls here, as far as trading activity is concerned, according to the Intesa block indicator, another metric we monitor every week is the amount of bitcoins on each holder's balance sheet. And as we're seeing some serious accumulation, the ones that are down are the ones that started their wallets a month or less ago, and that's because in that time, they've withdrawn more than 15%, but the rest category of holders are on the upside. Then the month to year, there's a 3% increase in wallets. Now, the metric we're looking at shows us how many wallets on the Bitcoin network have on the Bitcoin network with one balance or another. So we can see that the small and not so small holders have been doing quite well all week long. The only thing wallets with a balance of 10 or more Bitcoin balances got a bit nervous as the Federal Reserve meeting. Federal Reserve has caused a lot of people, judging by the traditional market, to reconsider some of their views. Addresses with 100 or more Bitcoins also fell. Have also declined. And the strongest category is the 1,000 plus Bitcoin is up slightly weak and Bitcoin hasn't risen much at all, as we can see in this chart. And of course the behavior with the nervous behavior of Bitcoin, but with a bit of a time lag. Super whales, as we can see, rising oil, shut down in the United States, bad economic indicators of America, which into an economic hole, all these things that we've been talking about this week. But what could not be discussed was the opinion of the individual members of the Federal Open Market Committee, because they're having a sort of kind of lunch break before the meeting. And as soon as it's over, they start to speak out. And believe me, these statements that we're getting are just only add to the negativity in the market. At least two of the Federal Reserve have said that there may be another rate hike and that borrowing costs may have to be extended. And it would have to be extended long enough for the Federal Reserve to bring inflation down to its target of 2%. Michelle Bowman has signaled that it would take more than one rate hike, consolidating his as one of the most hawkish of the Federal Open Market Committee. Of the Federal Open Market Committee, she said she still expects that it's more likely further interest rate hikes to bring inflation back to 2%. She made the comments to an audience of independent bankers, including the president of the Federal Reserve Bank of San Francisco, Mary Daly said she was not ready to declare victory on inflation and that the central remains committed to containing price to keep price pressures as possible. We will not be satisfied with what has been done and we are seriously frustrated that inflation has not yet been able to come anywhere near our level. Until there's more confidence that inflation will return to price stability, we're going to be tough. Powell is still Powell. Of course he influences the members of the committee. But as we know, there's a lot of hawks on the committee. 12 out of 18 voted in favor of tightening policy. There's no unanimity, but the desire for economic tightening. We'll see on Saturday and Sunday. Subscribe if for some reason you're not already subscribed. Please click on the bell so you don't miss out on new videos, because there will be more to come. Bye bye.